And today, we're in the process of addressing that one final issue that's been holding us back.
Okay, which is a large raise. It's quite a big number, like over $40 million. It's not to be ignored. You know, your market cap is around what, 28, 29 million bucks, and you're raising $40 million. Why so much money?
Well, we have to be careful. So I'm going to kind of step into the Australian dollar rather than the US dollar. Um, and we'll talk Australian dollars for a little while now. Um, our debt in Australian dollars is about $27 million. And our capital raise, we're looking at about $40 million on the raise. So the purpose of this raise is to entirely eliminate that debt in the nearest prospect that we can. And then we'll be, taking on some additional funds to carry our company forward with the initiatives of improving the low pH technical understanding, some optimization, some de-risking of our project moving forward. The scale of the raise is really one that is recapitalizing the company. Going after a rather large raise at this time. The fundamental purpose is extinguishment of the debt. Everything else that we're going to do, could have been done with a much smaller raise, but the debt extinguishment is the main purpose.
Right. Okay. And I do understand that. You've had conversations with the lender. You've extended it a few times over the past few years. They've reached the end of their tether, have they? I mean, I know you kind of got extension from, again, April through to end of June.
Yeah, look, Matt, we took this debt in 2016 when the company had just stood up the project and was just beginning production. Over the last 4 to 5 years now, we've extended the debt on a number of terms. We've changed the conditions on a number of times. And today we really do believe that, with the debt coming due at the end of October of this year, we really do face a very real prospect that the investment horizon for those lenders and that lender group is really near the end, and we're not certain that we would be able to extend or change the terms and conditions of the debt moving forward. Beyond that, and we pay $3 million a year, Australian, in interest and servicing of that debt. So that's a big chunk of corporate burn that's being financed by our investors. So it's important for us to look for ways to reduce our burn rate, reduce our costs of moving forward, and so extinguishing the debt became a real priority for us.
But why this method? Why a 45.4% discount to the share price, as I think it was at some point in May? That's hugely dilutive, isn't it?
Yeah, well, we recognize the offer price is a significant discount to our last closing price or to the pricing of our last capital raise, which was completed at the beginning of this year. The COVID-19 influenced markets today, and in those markets, equity raises that are primarily for the repayment of debt or for the restructuring of a balance sheet are being similarly priced. This is a substantial discount, but it's in the ballpark and the same pricing as you would see if you looked into the universe of other raises trying to accomplish the same thing. Matt, we priced this rights issue to minimize the execution risk. We think the pricing puts values in the rights for the shareholders so that they might clear the market if any current shareholders did not wish to or were unable to take up their entitlements. These shareholders may be able to realize some value by selling their entitlements in the market because of the way we priced it today.
So who recommends to you that's the price? And what was the starting price? I'm assuming you negotiated it, but it's still 45.4%. So what were they originally recommending?
Well, this was you were looking at a 50% discount. We weren't quite at that level, but you can see raises of this type in the markets today, offering 30 to 60% discounts.
Yeah, well, it's pretty much. I think the retail investors is kind of taking their breath away. They're not quite sure what to make of it. And so well, you tell me, what do you think they should make of it?
I want the retail investors to be assured that the form of this capital raise was selected because it puts our current shareholders front and center first. They have first rights to take up this well-priced offering. We didn't do a placement to institutions in advance of opening up this rights offer. This rights offer goes to our shareholders first, and if they take up their rights, nobody else will. Now it's fully underwritten, and it's been underwritten by Canaccord and a group of sub-underwriters. So if the shareholders do not exercise their rights or opt not to for one reason or another, we can be assured that this raise will be successful. But very important to the board, very important to the company, was the treatment of our existing shareholders, and that's why we selected this form of a raise. And it is inherent with this type of a raise that there are generally larger discounts. But again, each of our current shareholders has the first chance at these well-priced new shares.
Okay. What were the other options you looked at?
For the last 18 months now, we've been negotiating an arrangement that would achieve a partial monetization of one of our offtake contracts. And the intent of that monetization was to repay the debt. That's been a part of our story. But the viability of that arrangement really depends on the ability to purchase uranium in the spot market and at the time of execution. And the ability to buy at a price that would generate a significant upfront payment to the company. With the recent increase in the spot price of uranium, the upfront value for monetization type of transaction has diminished significantly. So the appeal, the attraction of the monetization is not what it once was. And for us, we're being mindful of the proximity of the maturity of our debt. We did look at all of our realistic options for the company, and we took the prudent decision, we think, to avail the company of what is a fairly certain market right now. The Australian market is a pretty buoyant fundraising environment at the moment. And it's not always like that. It hasn't been under the COVID environment. There's been a lot of uncertainty in the markets, and it may return to a volatile and uncertain market. So we see this as a good time to remove the specter of the long-term debt. We think this was the best mechanism that we could look at. We value our shareholders, and we put them first in line for this raise. And really, other mechanisms that didn't put our shareholders today first in line were quickly eliminated.
You must have been one of the few uranium companies wanting the spot price to stay low then.
Well, that is the irony, Matt, of our position. The monetization depended on a low price, and the markets were low for a long time. But the monetization transaction was just simply not getting done with some of the negotiations and the agreements that had to be completed. We had a structure that we thought was a win for all parties, but there were some contract details that weren't working out. We've looked at it. It's gone on long enough. We needed to reduce, the price of uranium going up was against the interest of the monetization, but Matt, it certainly is not against the interests of the company in the long term.